Welcome to the big show. It's the Retire Young radio show. If you're a first-time listener, thanks for stopping by. I am your host, Joshua David, and we are always happy to have you with us today. Once again, I have my great friend, my great pal, and Al. Pal and Al, how you doing today?
I'm doing fantastic. How about you?
I'm doing good. What's that quote? I'm a poet and didn't know it.
That is a quote, yes.
Let's move on to the financial markets.
I think it's time to move on.
Yeah, it's always great to be back helping our Retire Young family make better investing decisions. Al, we had another great week in these markets. We had some pretty big movements, especially last week, the gold and the silver markets. Mm-hmm. We're seeing some more volatility coming in this market, which is good, but it's bad for people that don't know what they're doing. That's why we help so many people all across the country with financial literacy and just to help people make better decisions in their income accounts or retirement accounts. So, Al, what is going on with all this volatility that is happening? But most importantly, how can the average investor or us as the public take advantage of these moves and kind of trade like an institution and not against them?
Well, it's been an interesting market and will continue to be so for some time. But this market is really driven by optimism, not by economic fundamentals. And there's this disconnect. We talked about this before. And so instead of reflecting really what's happening in the economy now, the market is reflecting what people hope the economy will look like in the future.
That's what they call smoking the hopium.
That's exactly, there you go with your poetry again. Yeah, absolutely. And we're seeing a lot of different things now. We're seeing new people in this market. And I think if you look at what's happened with the stimulus, activity that has been present and with the $1,200 stimulus checks, a lot of new accounts have been opened up with exactly $1,200. So there's a lot of people that are using that money to participate in these markets. And I think what we're seeing is a lot of people that are pretty super aggressive in what they're doing, and they're just kind of following what I guess we would call a momentum strategy, which is fine. The market has been providing some great opportunities, but for people that don't know what they're doing, that really are just kind of throwing money at the market, it's going to be we don't know what's going to happen. You can't control what's going to happen. This market is going to do what it wants to do when it wants to do it. What you can do is control yourself, and that requires some knowledge, some education. You can't react to what you think the market should do, again, because it's going to do what it wants to do. Really what it comes down to, Josh, is controlling what's between your ears. This is a critical time to get the proper knowledge, to start building up the skills, because the opportunities are fantastic out there, and we don't know how long these kinds of opportunities are going to be here. At some point in time, the volatility will settle down, and for people that are looking maybe at trying to get some benefit from these markets short term, the volatility can be used to your advantage if you know what you're doing.
That's the key. Is we're seeing a lot of volatility, which some people are afraid of, but the volatility, which is basically just buying and selling in the markets, that is actually a great thing. You just want the markets to move, and that's why it's important to trade or invest kind of like an institution would do it with a plan. But let's get into, Al, how the financial markets really work. How does the stock market really work?
Yeah, and that is the key. I mean, think about why you are participating in the stock market, and it's to profit from what the market is presenting. And regardless of what it's presenting, there are strategies can be used in any market condition, but it's getting the proper education to do that. And part of that is understanding how the markets function. And really, think about it. What is the key? If you're going to participate, isn't your goal to get into something at the lowest possible price at this particular moment and then get out at the highest possible price with protection in case you're wrong? It really gets down to identifying the proper price. And that is really based on supply and demand. In these markets, and we talk about the markets, we're talking about the stock market and then the other markets like the futures, forex, and options market. Most people are familiar with and participate in the stock market. And when you look at prices, what causes price to change? Why does price go up? Why does price stop going up and start going down? Really, it gets down to institutional activity. It's supply and demand, that basic concept, which is a factual thing that really can't be argued. When there's more demand for something, when there's more buyers for a product, for a stock, for example, the price is going to go up. When there are more sellers for it, price will go down. So the key is identifying when those prices are going to change, and they always change. The turning point always is when that supply and demand is out of balance. So the key is identifying where the supply and demand imbalance happens by big players, by the successful, by the pros, by the smart money out there, the institutions.
So who is like the big banks and
You
everything?
were talking
Goldman
about-
Sachs,
Sure.
Warren Buffett,
Right, maybe hedge fund managers, but most people are familiar with the big banks: Goldman Sachs, J.P. Morgan, Morgan Stanley. When they're trading, they're not buying 50 shares or 100 shares or something. They're buying in huge quantities, enough to move the price of something. But they also understand that they have to do it in a smart way. They don't want to, and I guess you could say, tip their hand and let other people know that they're going to take a big position. So they might do it in increments. And the strategy that we use, that our students use, identifies where that initial trade is going to take place, and then we benefit from what we know is going to happen in the future. And we know that not all of an institution or a big player's trades get filled at one time. So we're ready. We're positioned for the next move, the next part of what their trade is going to be, whether they are buying, going long, or selling, going short.
Well, that's all about being proactive rather than reactive, having a plan to do that. So understanding where these banks, these institutions, or we call it the smart money, where they're investing, where they're buying and selling. That way we can kind of jump on their coattails, because we're not going to move the market. The big money is what's doing that, the millions and billions of dollars. So just understanding how price action moves on a chart or looks on a chart, which is supply and demand, and having those low risk, high reward, high probability entry points into the financial markets. And Al, we have a lot of investing classes that we do right here at the Academy, and you teach a lot about stock and how that really works and how us as individuals can participate within the stock market. Al, coming up in the next segment, we got a lot to discuss here. We have a lot of listeners that we've been hearing some feedback about. They want to understand more about how the smart money is creating income in these markets, because we all know the stock market. So they want to know more, how can individuals use the stock market for that income, like the institutions or the smart money. So coming up, how the stock market works to create income like the institutions. This is Josh and Al. We will be right back.